range trading option strategy, and a variation of a similar option setup called the Iron Condor. Both these strategies use a combination of two credit spreads, which face in opposite directions, calls, on the upside, and puts, on the downside. The difference between the two, is the range of option strike prices used. The Iron Condor has 4 different strike prices and uses only, out-of-the-money short-sold options, for the body of the setup. The Iron Butterfly on the other hand, focuses on using just one, at-the-money strike price, at which, both call, and put options are sold. This is known as the body of the butterfly. To these, we add 2, out-of-the-money bought call and put options, which comprise the wings of the butterfly spread. As a consequence, the Iron Butterfly brings in a greater credit, in comparison to the Iron Condor, and this is due to the higher priced, at-the-money options that are being sold, but it also involves a greater risk. The risk is that the underlying stock price action will penetrate the wings before expiration date. This is because the wings will usually be closer to the current trading price of the underlying stock, at the time when you enter the positions. Butterfly spread versus the Iron Butterfly. We also need to distinguish between the concept of the Iron Butterfly strategy and another one that is simply called the butterfly spread. The butterfly spread consists entirely of either all call or all put options, but not both. If we were to break apart the regular long butterfly spread, we would notice that our butterfly spread is simply a credit spread and a debit spread, that as far as strike prices go, sit one on top of the other. When you enter a regular long butterfly spread trade, you will usually see a net debit to your account. The Iron Butterfly on the other hand, uses 2 credit spreads, known as a bear call, and a bull put spread respectively. These 2 credit spreads are what creates the iron part of this strategy. The idea is, that you are bringing in a double premium and a net credit, in the knowledge that whatever happens from here, only one of the credit spreads can lose money, if you let them run to expiration date. Let's look at a theoretical example to illustrate. A stock is currently trading at $40. Therefore options with a $40 strike price will be at the money. We believe this stock will continue to trade within the range of $35 to $45, up until the time our option positions expire. We use the same number of option contracts for all positions, and we'll assume that the options will expire next month. We're going to break our Iron Butterfly spread into 2 segments. 1. The bear call credit spread segment. Sell $40 at the money call options, and buy $45 out of the money call options. 2. The bull put credit spread segment. Sell $40 at the money put options, and buy $35 out of the money put options. From the above we can see that we have taken out 4 options positions simultaneously, with a common, at the money $40 strike price, for sold calls and puts, to form our Iron Butterfly. But breaking it down, we have 2 adjacent credit spreads, facing in opposite directions. Characteristics of the Iron Butterfly spread. Limited risk. Your risk is the difference between one of the strike prices on either side of the middle common strike price, the body of the butterfly, less the premium you have received from selling both at the money call and put options. If option implied volatility is working in your favor at the time you take the trade, this risk can be minimal. Limited reward. Your profit is limited to the premium you take in from selling at the money options. Collateral required. Normally for credit spreads, you will need sufficient funds in your broker account to cover the difference between strike prices, multiplied by the number of shares the option contracts cover. However, since it is only possible for one of your positions to be unprofitable at option expiration date, some brokers may take this into consideration and allow you to only allocate enough margin on your account necessary to cover one side of the spread. Recommended strategy. First, You identify a stock that you believe will be range-bound at least until the expiration date of your iron butterfly position. Looking at monthly price charts can give you a clearer picture in this regard. Second, you should examine the current market price of the stock relative to the option strikes necessary to establish the strategy. Then evaluate the risk-to-reward ratio before placing the trade. The basic idea is to take advantage of option prices that will allow you to get into the trade for a maximum credit, in comparison to the potential risk at expiration date. For example, if you see an iron butterfly opportunity following a large price move, option implied volatility may work in your favor, so that your sold positions, relative to your bought ones, could result in a very favorable risk-to-reward ratio. Exit strategies. You do not need to wait until option expiration date to exit your position. Providing the stock remains within the range you anticipate, this allows you some flexibility as the options approach expiration date. You simply evaluate the profit level of your trade, in comparison to its total profit potential, within the final 2 weeks, and exit when the market price of the underlying is closest to your at-the-money options positions. However, if the price of the underlying should surge away in either direction and breach the outer strike prices, you can do one of two things. Either exit the losing position and accept a loss on only one side of the trade, or, depending on where you think the stock may go from here, you could take advantage of a nice characteristic of credit spreads. 1. Roll the losing credit spread up or down, if you catch it in time, or 2. Roll it out to a later expiration month, while letting the other credit spread expire profitably, and without risk. Thank you for watching. If you like this video, please subscribe to our channel.